is the number one thing. If you can learn this very thing, you'll be very successful at this. And it is price is king. Are we doing that? How true is that? That's it.
It's all about price.
It's all about price. Being able to buy and sell at different prices and hopefully higher to make money. That's it. That's all this game is. That's all it is how do we look at it and say, it's going to go here relative to what I see, or it's going to go here relative to what I see. How do we do that? And that's really what I'm here to teach you, is how to analyze price to say it's going to go up from here, it's going to go down from here, and it's going to be relative to 4 or 5 or 6 series of parameters. Now the next thing I want to put up here is there are 3 basic market environments within the stock market. Markets go up, markets go down, markets go sideways. Rules don't necessarily change relative to direction, but the style of trading changes relative to direction. It's so common if you're looking at charts and you're trying to analyze this stuff and you're in an uptrend to say, oh, well, it's already gone up so much, I need to get out. So the idea is, the mindset would be to violate the trend, mean reversion systems. You don't want to do that. Trade the direction of the trend. But what a trend is a trend is a series. To be able to identify a trend, you need 4 points of data. Okay, so an idea would be you need a high, a low, a low, high, a low, and a high. That determines a trend. What I mean by trend, so that would be what we refer to as an uptrend. Okay? Downtrend is going to look very, very similar. Sideways trend. Very, very similar, right? 4 points of data to determine what that trend looks like. Okay? Now, that may seem extremely basic, which it is, but then as you see this, is you can start to identify trends on what time frames they come in on. On any one given chart, if we go back to our investor, position trader, swing trader, day trader, scalper, high frequency guy, they're all looking at trends. They're just looking at them on different time frames. That's all they're doing. You're thinking in terms of minutes, you're going to use a 5-minute chart. You're thinking in terms of days as a day trader, you may use an hourly chart. If you're thinking in terms of swing trading, you're going to look at a daily chart. You're going to look at different charts, but you're going to extrapolate data from each one of those. Now, trends always form. This isn't always, this is an absolute. This is like the water being the level. Always start on the shortest time frame first. A trend will form on a 1 minute before it'll form on a 5 before a 15, 15 before a 30, hour, 4 hour, and daily. So trends will always start down here first. They'll, turn trend, and then they'll start going up, and then the 5-minute will kick in. And what's cool about it is if you can understand what the trends are, one cycle larger than you. So let's say we're day traders or swing traders or scalpers. If we know what the guy right above us is doing relative to how he's trading, we can capture a short-term trend against his big-term trend. Because there's more traders. There's not many guys that sit in their underwear and click the button, right? But there are a lot of swing traders. There are a lot of guys that position trade. And they're in it for weeks. So when they drive those moves, they want big movements. They don't want, for us, but if we can trade short term amongst their big trends, we gain a ton of momentum. Market will really move in our favor. Does that make sense? Okay. So always be aware of one time frame higher than where you are. Next thing we want to look at is, again, if it's a trend is 4 points of data, what I'm drawing here is I'm drawing low to high, low to high, low to high, low to high, low to high. You can see this identifies a trend. Now, with that said, you have 2 basic movements. You've got this movement here. Let's say this goes up $5. Let's say this goes up $7. What can we automatically assume about the momentum of this trend if this was a $5 move and that was a $7 move? Is the momentum increasing or decreasing?
Increase.
Increasing, right? Let's say this is 10, what can we assume here? Again,
Still increase.
yep,
Increasing less rapidly.
yep, slowing momentum, right? So part of what we do when we look at trends is we start to say, okay, is this trend relatively strong or weak? And we'll compare this trend to other trends. So, relatively speaking. Then what you also have is you have what's called an impulse, and then you have a corrective trend. So whatever the impulse, we always trade the direction of the impulse wave. So what you'll notice as it relates to the, as we get into candles, impulses will always trade outside of each other. Corrective will always trade within each other. We'll get a bunch of these bars all within each other. So we always look for, whenever we look at a chart, we're always going to look for impulses. I don't know if you've seen how gold's doing over right now. Huge impulse. So we always identify our impulse legs, and we identify the pivots of our impulse legs, and then we identify the corrective pivots off of our impulse to look to take it higher. This is going to go higher once we identify the impulse wave. And we're going to talk more about that, and really buyers and sellers and what's going on and that types of stuff. So what you have in any environment, and this is what causes momentum to increase outside of time frames, is you have 4 people that are playing a game of tug of war. So if you buy a stock, what must you do to get out of it? Gotta sell. Right? Now if you sell a stock short, you've got to buy to cover to get out. So you have 2 buying and 2 selling is kind of the moment. They're going different directions, but they're causing different things. So what will happen, let me just give you an example. If you have people that are buying and buying to cover, meaning they were short but now they're getting out, that stock's going to be a major, major impulse. Right? Because they're both buying pressure. Two people buying. If you have buyers and sellers meeting, they're at a standstill. Equal relationship, just like real estate, you'll understand this. If I've got, let's think real estate here. I've got 100 homes to buy and 10 sellers. What's going to happen to the price of that home? The price of these homes, these 10 homes. They're going to increase in value or decrease in value? You increase in value, right? Because you got 10 people going after 10 houses. If you've got 10 buyers and 100 sellers, what's going to happen to the price of those properties?
Go down.
It's going to drop, right? Let's say we have that. Equal buyers, equal sellers. 3 modes of the market. It's what controls it. Buyers and sellers. Same thing here. So short selling would be basically like short sell to a bank. No, same similar process. And then they're looking to get out of that home. They're looking to sell that to another investor just to get it off their books, right? At a major, major discount. It's a very similar concept to real estate. So you always got to know who's in control and who's in the markets and who's doing what. But let's get back to trading.